Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Here's what we're watching this hour. First up, we'll break down the market volatility and how investors should position going into the end of the year. Plus, we hone in on the state of the consumer as retailers gear up for holiday shopping. And airlines are bracing for record travel this Thanksgiving. Will the government shutdown have any lingering effects on travel and earnings? We'll tell you coming up. But first, let's take a look at the major averages. We do have a rally today, but there's a real sort of disconnect between two of the major averages. Right now, the Dow is only up about a little more than 70 points, not even 0.2%, but the S&P 500 is gaining 0.9%, and the NASDAQ composite is leading gains, up by 1.7%. So interesting action that we are seeing here after the negative week that we had last week. We continue to see a little bit of pressure on yields here and rising expectations that perhaps we will get a rate cut in December. That's been one of the things that's been fueling some of the gains, and we continue to watch the action in cryptocurrencies. While Bitcoin is up off the lows, it's down another 0.8% in this session, and Bitcoin's sort of been leading in recent weeks, especially leading tech stocks. So this perhaps is leading some market participants to ask, are we then going to get more of a decline in stocks, or are we going to get a bounce in Bitcoin? So question that is lingering as we head into this holiday shortened trading week. Interesting action today in large cap technology. We see a little bit of pressure on Nvidia, but of course the real standout continues to be Alphabet, which again trading at a record here, up by more than 5.5%. And if you look at this year-to-date action here, you see it up 67%. So is the best performer among the Mag 7 far and away this year. And again, as I mentioned, trading at a record. And we also have seen the market cap of Alphabet as a result of those gains now surpass that of Microsoft. So this is the market cap weighting here. Nvidia is still the biggest at almost 4.4 trillion. Apple over 4 trillion. But Alphabet's gaining on them, about $3.8 trillion market cap, as Microsoft has fallen into that fourth spot. So interesting action that we're watching there. Now, I mentioned that sort of divergence between the Dow and the NASDAQ, that is the NASDAQ gaining a lot more than the Dow is today. Here's a look at what is moving within the Dow and why there's some perhaps more declines or less gains, I should say. You've got P&G, Procter & Gamble lower today, Coke, Verizon, Disney. So those are some of the stocks that are holding back gains. And then looking at the sectors in the S&P 500, we've got energy and consumer discretionary on the way. In consumer discretionary, we just talked about P&G being lower, but then you've got tech and consumer discretionary that are leading gains today. So we'll be continuing to watch those sector movers to see if we continue to get some rotation as we have been in recent weeks. Well, consumer spending is also in focus this week. Well, Black Friday is officially kicking off the holiday shopping season. Investors are also closely watching more retail earnings on deck. Joining me now, Jerry Storch, Storch Advisor CEO, former Toys R Us CEO, and former Hudson's Bay CEO. In other words, a retail veteran, to be sure, Jerry. It's great to see you. It's funny because I mentioned that Black Friday sort of kicks off the holiday shopping season unofficially, but I feel like the holiday shopping season starts in October now, right? People start shopping early. The early indications that we've seen, how do you think the overall season's going to be?
Look, we're still flying blind because of the lack of government data, but generally what I've heard is it's okay. And you're right. The holiday season really starts off with Amazon Prime Days in October now, and then it rushes towards holiday. There's still a long way to go, however. The consumer has held up very well all year, despite concerns about inflation, jobs, tariffs. There's been a lot of worry, but the consumer has kept spending. The year-over-year growth in the last report we had, which is getting pretty old, was 5%, which is a very healthy number. And I've heard from credit card companies, others, that's kind of where it's holding, which is darn good.
And how do you sort of square that, Jerry, with the negative vibes out there, right? For lack of a better word, right? We keep hearing about the K-shaped economy that lower and even middle income Americans are having a tough time right now, right? We see the sentiment surveys; those haven't stopped, and those aren't great. So how do you sort of square that with the spending?
Right. Well, great question. But everything's relative. I don't really think there's a K-shaped economy. People keep saying that. I'd like to put a stake through the heart of that. K implies one part is rising, another part is declining, the bottom part of the K. That's not what's happening. All the parts are still rising. It's just, of course, the higher income areas with a growth in the stock market are rising at a faster rate. The lower income areas are rising at a slower rate. But they're still rising. Wages are still exceeding inflation. It doesn't mean people aren't feeling stress. The cumulative effect of years of inflation definitely weighs on people. It doesn't mean lower income strata aren't spending more on necessities instead of fun stuff. But they're still spending when you really look at the data, at what's actually going on. So that's why I feel pretty confident the result's going to be pretty good for the holidays.
Jerry, there is a word that I don't think I heard before the past few years, and that word is choiceful. And that seems to be the word of retailers over the past couple of years, that consumers are being more choiceful, right? That they're being, I don't know how else you would say, more particular, I guess.
I don't know. I think there are winners and losers. There always have been. People are saying that. It's funny how you hear about all these terrible things from the people that aren't doing well, but then, Walmart is thriving. They're doing, fundamentally, excellent on every front. TJX keeps doing well. Costco keeps doing well. Amazon keeps capturing market share. There are certainly people who are losing, like Target, is one that's absolutely losing. Then you see someone like Gap. I saw you flash that up on the screen. Here you have a new CEO come in. This is a company a lot of people have given up for dead. They're thriving. They're doing fantastic. Well, what does that mean? How is that choiceful? Maybe they're just choosing the stuff they want to buy, not going to the retailers or trying to sell them stuff they don't want to buy. There is a theme of value, and that's been true probably for a decade, where retailers provide great value, have been capturing market share. And again, Costco, Amazon, TJX, and Walmart are the giant winners. If you really look at the numbers, they have captured just massive market equity capitalization share of all retailers, as well as market share among consumers. Not even, TJX, this is the smallest one of those. Their market cap is $162 billion. Target's only $39 billion. It's like, wow, things have changed. And that didn't happen in 1 year.
No, that is an incredible perspective on that. And everybody, all the stock pickers within retail who we talked to lately love TJX. I got to say, Jerry, that's a name that keeps coming up again and again. What else do you think people are going to be buying? What other trends do you think we'll be seeing? Is it going to be like apparel, or like what gifts are going to be popular, do you think, or what categories?
Well, I do think apparel is going to be popular. Obviously during the pandemic, people held off. Apparel has been stronger than maybe it should have been. It's one of the places that has the greatest inflation, by the way, from the tariffs, because most of it is imported. Yet people like to buy apparel. There's probably still some pent-up demand there. I think that's an area that's going to do better than it has historically. Don't fool yourself and think it means all specialty apparel places are going to do well. Only the ones who have people want, like Gap as an example, or Abercrombie or someone like that. Don't think that means department stores are going to do great. People are shying away from department stores. They may do better than very low expectations, but they have been, increasingly shrinking into irrelevancy to consumers. That's not where they need to go anymore. If they want a department store, they have one called Amazon. So don't conflate apparel with all apparel places. Apparel in places people want to buy what they're selling, like the app.
I got to tell you, my 13-year-old told me clothing is not a gift. But that's probably just me. And then,
well, they never think that. They want video games and toys.
Of course. And then I'm also curious about the interplay between online and in person at this point, Jerry. Am I going to be able to get a spot in the mall parking lot on Friday, or are we still going to see a lot of people going into those stores?
Well, what's happened is all the Black Friday deals are almost all of them are available online. And so it almost starts Thanksgiving Day before any stores are even open. So Thanksgiving Day is huge online. Black Friday is huge online. And then, of course, you go right into Cyber Monday weekend, and Monday is huge online. So a lot of that volume, clearly, of that sort of urgency has shifted online, where you're sitting there hovering over the keyboard trying to get that deal. There's no doubt about that. So you're going to see little bursts of energy at the stores when they have their opening specials, doorbusters, things like that. Then it's going to die down, and the afternoon is going to get busy again. It really will, because people are bored. Those who don't want to watch, I always say, instead of the football games, they want to go shopping. People will be out there. So I think you're going to have a busy Black Friday, but it's not what it used to be, because online has stolen a lot of the immediacy from the day.
Right. Jerry, great to see you. Thank you so much for the time. Appreciate it.
My pleasure.
Up next, the holiday season often means a December bounce for stocks. We'll discuss why this year the traditional Santa Claus rally might not be coming to town. You're watching Market Catalyst. Usually at this time of the year, investors expect any market volatility to be swept aside by an incoming Santa Claus rally in December. But 2025 isn't a usual type of year. A soft labor market and sticky inflation are two factors that could cause Santa to take a detour and skip the usual December bounce. Joining me, Omar Aguilar, Schwab Asset Management CEO and CIO, and Amy Wu Silverman, RBC Capital Markets Head of Derivative Strategy. Thanks to you both for being here. Amy, I'm going to start with you because I know that you watch volatility very closely. We've been seeing an uptick in volatility recently. How do we know if it's going to stick around into December and make December unusual?
Yeah, it's interesting because seasonally, when we hit Thanksgiving, then volatility starts to slow down a little. You get that grind, and then you get that Santa rally. You know, Julie, if you look at all the months this year, none of them have behaved the way they have seasonally. And I kind of expect that to continue because we're actually seeing in the options market a pretty big increase in bearish sentiment that tells me that investors are starting to think more about hedges. And frankly, they start to work a little bit more, which has increased the demand on the downside. So I don't know if we'll get that Santa rally, but we'll definitely get perhaps another volatility pothole or a rally in volatility.
Omar, what do you think? Do you see also that there are some sort of fundamental speed bumps maybe between now and the end of the year?
Yes, we see a lot of dispersion and a lot of discrepancy across many things. On one hand, we're getting new economic data. So at the macro level, we're starting to just get data that we didn't have for several weeks. And that's sort of been absorbed by the market, and that has created volatility. We have seen parts of the beginning of unwinding of that momentum trade that we have talked about since April, and that has put areas that have been done very well this year to start losing some performance. So we see some of those fundamentals going into there, and the opportunities for a catalyst that will propel the market up don't seem to be that strong this time. Maybe the Fed cutting rates will probably put that extra piece to just get the market going, but it's still unclear that will happen in December.
Omar, any other catalysts upcoming either between now and the end of the year, early into next year, that could be positive for stocks or negative? Or what are the big events that you've got your eye on?
Well, as I said, the first one starts with the Fed. And I think within the Fed is not a foregone conclusion that there will be a Fed cut because there is discrepancy within the Fed members and the committee from, on one hand, the discussion and the discrepancies between what we have on a sticky inflation and a potential softer labor market. And those two seem to be collapsing. And then that created that. Now, if they were to go and create, and today the probability of a Fed cut is up to 70%. And it just happened, to go from 40% to 70% over the weekend. That actually could provide a catalyst. The second one is the continuation of a confirmation that the AI capital expenditures continue to grow. And I think that if you can start seeing signs that there are potentials for that AI return on investments to start consolidating, that could also be another catalyst. And of course, in this part of the year, seasonality will play put a lot of attention on consumer spending, and a big part of how consumer confidence goes into the end of the year will potentially be another catalyst for the market to take off.
What about you, Amy? As you look into December, specifically about the Fed and the possibility of a rate cut or not, how are you thinking about that, and what are you seeing in terms of what's being priced into the market here?
Yeah, clearly a lot of what's been going on in the market has been highly correlated to the Fed. And, when you looked at that December pricing and it looked like we weren't going to get it, we got that tantrum, and then Williams comes out and says something, and, the toddler's a little bit relieved. I would add one thing prior to the Fed that I think is going to be very important, which is actually Oracle, because of so much of the credit issuance you've seen. You've seen this huge divergence between what we see in the credit markets in terms of spreads widening and actually equity volatility not catching up. So I think, one, that'll be important as the catalyst. And then two, obviously the Fed decision. But beyond that, also who the next Fed chair will be and how amenable that Fed chair will be compared to Powell to doing something different as we head into 2026, Julie.
Something I know that you are also watching, Amy, is sort of the right tail. What do you mean by the right tail, and how's that playing into the market environment right now?
This has been such a huge change in our markets because I would say most of the time investors worry about what can go wrong. And they've really had to worry in 2025 about how much can go right. And the reason is you've got this heavily concentrated market. You know, you get a little bit of FOMO and YOLO, and you have investors who can't risk being underperforming their benchmark by a substantial amount. And so we really seen these up crashes where investors are piling into call options. You know, retail is a big element of that. And the fear of missing out and the fear of, again, dragging that benchmark has been just as important as the other way around. What we're actually seeing now, Julie, is a normalization of that because this whole year has really been about that right tail being risky. We're finally starting to see machinations that maybe the left tail is important as well, and we shouldn't ignore it.
So Omar, if we put all this together and we look at the dominance of the AI trade and what we've been seeing thus far, and Amy, your point about Oracle earnings being an important catalyst is well taken. We'll definitely be watching that when it's due on December 8th. Omar, what are you recommending that clients do with these AI stocks right now?
Rebalance. This is the time for many reasons, from tax efficiency to just risk assessment to risk budgeting. You know, we always encourage our clients to look at these opportunities when volatility is high, to basically find the opportunities to recalibrate their portfolio and position it, you know, for next year. You know, whether it's equities, fixed income, or just overall, you know, their entire structure of how they want to position their portfolio with their investment objectives. This is the right time to do it. When you think about the prospects of going forward, starting with fixed income, clearly a steepening yield curve will favor for clients to start thinking about, the increasing in duration, staying up in quality, because there's really no reason to go into have a heavy credit exposure. But this is a good opportunity when you look at just the results on investment grade this year. They have been great. Those bonds have actually done their job on providing that stability and diversification. So this is the right time, if you don't have enough fixed income exposure, to try to think about it. And then within equities, again, reduction of that momentum exposure when you have areas of technology and a lot of those large caps, a lot of those, cryptocurrencies. This is the opportunity to try to deploy, assets into areas that haven't done as well. A little more mid cap, small cap, some cyclicals, and then trying to just to look for what may happen going into next year, mostly, related to fundamental and macroeconomic drivers.
And Amy, what about you? Any tips for investors going into the end of the year?
So structurally, we like looking at really expensive stock option premiums on the upside because of that right tail of crash I mentioned, and using it to fund some kind of hedges. Because again, things have done well, and you're really at the point where I think a lot of investors are thinking about their 2026 risk budgets. They're thinking about stocks have done well, and how do I not necessarily take profits, but use those profits and put them in a way that I can also protect the downside.
Omar, Amy, thank you so much. Appreciate it.
Thank you.
Thanks. Former Federal Reserve Vice Chair Lael Brainerd joined Yahoo Finance Invest to discuss the Fed's path forward. Here's part of that interview with our Brian Sozzi.
Going into the December meeting, it's just much less clear where the Fed is going to go than it was back in September. And it's not primarily because of the lack of data, although the lack of data just makes it worse. It is because we have heard from both sides of the Monetary Policy Committee that both the hawks and the doves are digging in, with the hawks saying that inflation is 3%. It has been for 44 months now, and it is projected to remain in that territory because of the tariffs. On the other side, the doves are saying that the labor market appears to have softened given the last public sector data that they have, as well as some private sector data, and both sides are right.
Before the government shutdown, Lael, there was a general consensus that the economy was slowing down, as seen through the prism of U.S. labor market data. Why was that happening?
So I think we have a very clear two-track economy. We have the AI sector, and all of the related sectors are seeing record interest in the stock market, are seeing massive investments, data centers, electricity, chips. The leading sector is doing extremely well, but it's not hiring. And the rest of the economy is suffering. It's suffering because it is less favored in the capital markets. It's suffering because it is still trying to digest those tariffs. And then it's also, a lot of those businesses are not clear how much should they hire given what they're hearing about integrating AI into their businesses. So for all those reasons, neither the booming sector nor the remainder of the economy are really hiring. And meanwhile, you have very divergent economies.
Is the economy in a recession?
I would say you saw the second quarter growth number coming in very strong, 3.8%. Consumers remain resilient. Now, we know that that is the top of the consumer income distribution, but they do remain resilient, driving spending. And all the estimates are that third quarter GDP is going to come in quite similar. So the economy at the top level is strong, but again, it's being driven by this really important set of investments in AI. The rest of the economy under the hood is really stuck.
You bring up a good point, Lau. Why do you think the wealth we're seeing built at the top end, as seen through the prism, of course, of the stock market, why isn't that trickling down to the average household?
So you saw it in the election. Clearly, people in the lower half, even the lower 3/4 of the income distribution, are really concerned about affordability. They've seen prices of coffee and bananas going up, housing costs not coming down, utilities costs going up. So they're very worried about that, and they're worried that their job opportunities are not as good as they were a year or 2 years ago. You see that in the consumer sentiment surveys. Whereas that top 10% of consumers, their housing values have gone up, and of course their stock portfolios are very positive.
I'm glad you mentioned coffee and bananas, Lael, because the Treasury Secretary, Scott Bessent, is out this week saying the administration plans to put policies in place to bring prices down for coffee and bananas. Maybe this is the new egg debate. Whatever the case is, you're in government. Can the administration actually do this? Can they bring these prices down for these two key ingredients?
So, look, I think it is interesting, first of all, to see the Secretary of the Treasury and the administration wake up to the fact that people are really unhappy about prices and affordability. Don't forget, just a few months ago when they were putting tariffs in place, he was talking about how, well, there'll just be fewer toys under the Christmas tree come Christmas time. Now, I think they're seeing that actually consumers are really troubled by this affordability. And to some degree, they can take tariffs off where they've put them on. And that is what they're talking about. But it will be very difficult for them to fundamentally reverse the affordability crisis in areas like housing and, of course, in healthcare because of some of the expiration of the tax credits. It's actually going to get worse for millions of families.
Do you believe the higher prices we have seen, coffee, bananas, whatever it is, furniture, apparel, are tariffs causing this inflation? And then do you think the administration will come to regret these tariffs?
So look, I think in areas like baby clothes and strollers and toys, furniture, those are clearly tariff related. You can see the tariff lines. Coffee, bananas are hurt by tariffs, but in some cases there are structural forces that are making these worse. And so, for instance, the demand for electricity is growing at a rate we haven't seen in many years because of the boom in AI, and that is inevitably going to put pressure on consumer electricity prices. And that is something that is more complicated and difficult for the administration to reverse. Of course, it didn't help that they got rid of a lot of the alternative energy incentives. They have brought prices down. We're seeing lower prices at the pump by a little bit. But some of these other forces are going to be difficult for them to reverse without reversing their own policies.
I talked to a noted economist, Lael, Mohamed Al-Arian, earlier on at our Invest event. He said this, quote, "I believe that this Fed went to sleep." And Mohamed was referencing that the pressure, like you were mentioning too, on lower income consumers. Is the reality that the Fed, that meeting, December 10th, decision day, they need to come out here and cut rates and make it clear that more rate cuts might be needed to ease the pressure on households?
Well, I think they are in a difficult spot because they have the most powerful inflation fighting tool. And of course, with inflation now not continuing to come down, but stalling out around 3%, a little higher, they are concerned about inflation. I think most members of the committee believe that this is a transitory impact. They don't like to use that word, but they do expect the tariff effects to dissipate, so no further increases from tariffs eventually. And the other side of the committee, I think, has been sounding the alarm about the weakening labor market. And that was what we saw in September, very clear commitment to cut 3 times in those projections. But it turns out that 9 of the 19 members were not actually on board for 3 cuts. And so that is what we're going to see play out in December. Even if we see a cut in December, it's likely we would see a pause after that, given where the hawks are on the committee.
If you were still in the Fed, Lael, would you argue for a rate cut?
I would. I would be concerned about the weakening labor market. And I think I would take the risk that perhaps tariffs push prices higher for a little longer against the risk that we really see a self-reinforcing downturn in the business sector that leads to real pain for American households. So weighing those 2 risks, I think as many members of the committee, including the chair, has articulated, they are more concerned about the risk to the downside on the labor market. We just heard that again from Governor Cook. And they're willing to take a little bit more risk on the inflation side of the mandate.
Coming up, we'll look at the top analyst calls on Wall Street and some of today's trending tickers. Stay tuned. You're watching Market Catalysts. Welcome back to Yahoo Finance. I'm Brooke Tabama. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. We're watching shares of Baidu, Carvana, and Flutter Entertainment. That's the parent company of FanDuel. First up, Baidu. JP Morgan upgraded its rating on the stock to overweight from neutral and raised its price target to $180. Now, the firm expects its cloud revenue to increase more than 60% in 2026, boosted by its in-house AI chips. Next up, we're watching shares of Carvana because Wedbush upgraded the stock to outperform from neutral, calling it the new used car king. That's what Wedbush had said. The analyst Scott Devitt said it believes the recent pullback in shares is overdone and investors should take advantage of this period of weakness. The firm thinks Carvana will reach a leading market position by unit volume in the fourth quarter of 2026. And last up, Flutter Entertainment. That's the parent company of sports betting app FanDuel. HSBC upgraded the stock to buy from hold. And the analyst said to buy the dip after the stock is down more than 25% year to date. The analyst believes new state legislation in the U.S. sports betting market could be a potential growth opportunity for the stock. Keep it right here on Yahoo Finance. We'll be tracking all the market moves and top calls throughout the session. Now time for some of today's trending tickers. We are watching Alibaba, Nvidia, and Grindr. First up is Alibaba, Chinese e-commerce giant seeing a strong launch for its AI app. The rival to OpenAI's ChatGPT drew more than 10 million downloads in the week following its relaunch. Alibaba moved this month to rename and freshen up its existing apps under the Quinn brand. The company will gradually add agentic AI features to support online shopping as well. And by the way, Alibaba out with its earnings tomorrow, so we'll be watching for that. Next up, NVIDIA. Commerce Secretary Howard Lutnick said President Trump is weighing whether the chip giant can sell its advanced AI chips to China. Lutnick told Bloomberg the president is hearing from advisors to decide on the potential exports. Allowing H200 shares to China would mark a significant reversal of restrictions first imposed 3 years ago. NVIDIA CEO Jensen Huang has said China would be a $50 billion market this year. By the end of the decade, he sees it doubling to $100 billion. And finally, Grindr, shares tumbling after the company said it stopped talks on a take-private bid. The dating apps board ended the discussions amid uncertainty over financing the deal. Large shareholders made a non-binding, unsolicited take-private proposal last month. The committee determined discussions with the proposers were not in the best interest of the company or its holders at this time. Coming up, a look back at some of the highlights from Yahoo Finance Invest with some of the biggest names in AI, crypto, and more. We'll be right back. Yahoo Finance Invest highlighted some of the top leaders in AI and crypto. Here's a look at some of the biggest moments from the event.
All these things we've been saying for 20 years, and you know what? They pissed off a lot of people in the league. I run into people all over America and quite frankly all over the world. People who have like normal means who are now rich because of Poundry.
The math is pretty simple. We expect Bitcoin to appreciate about 30% a year for the next 20 years. There's no doubt in my mind Bitcoin will be a larger asset class than gold by the year 2035.
It shook us all to the core because fans need to trust that they are seeing real-time competition and that the outcomes are fair.
It was 9 p.m. in that AI party. It's now 10:30 p.m. But that party goes to 4 a.m.
There are elements of a bubble, which means that people will end up with losses. But the aggregate value of what's being created is significant. It makes sense to take a venture capital approach to AI. The payoff is so large that it is rational to have multiple investments and to overinvest.
The economy at the top level is strong, but again, it's being driven by this really important set of investments in AI. The rest of the economy under the hood is really stuck.
Government's going to change, tariffs going to change, leaders going to come in and out, and various other things are going to happen. You can never put all your eggs in one basket. That's always been the rule.
Vaccines have saved the world and will continue doing that. In the long term, it's the most cost-effective medical healthcare intervention.
We make an investment, and the management team, the day after we make that investment, I can promise you, they are getting together and they are going to do more than they would have done, faster than they would have done.
Most companies, when they think about their business, dealing with retail investors is pretty secondary or ancillary. They're worried about making sure that they're launching products. Our business is inherently different. Retail investors are at the core of not just our investor base, but also our customer base.
We're mining Bitcoin for roughly 50 cents on the dollar every single day, 24 hours a day. We're mining Bitcoin and we're adding it. And we believe this asset's going to be transformational.
Things were looking great. Then all of a sudden you have a shutdown that occurs, something that comes completely out of your control. We can't do business like that. We need more, from our government leaders.
Coming up, what record Thanksgiving travel numbers mean for airlines after the disruption from the government shutdown. We'll be right back. A record 31 million Americans are expected to travel over the course of Thanksgiving week, according to research from Airlines for America. It comes after a 43-day government shutdown that led to thousands of flight delays and mandatory cuts to flight schedules at 40 major airports. My next guest says despite the disruption, airlines' profits will likely emerge unscathed. George Ferguson, Bloomberg Intelligence Senior Aerospace Defense and Airlines Industry Analyst, is back with me now. Good to see you, George.
Good to see you as well.
So let's talk about the shutdown and the sort of hangover from the shutdown, first of all. It seems like we did see some change in behavior. Even if people are still flying, maybe they changed when they were booking with their flights because they were waiting to see what was going to happen.
Yeah, although, so as we get into Thanksgiving and the year-end holidays, typically we find customers or flyers, are booking, a lot further out the curve, as we say in the industry. So we're like a typical business flyer might book 14 days out or something like that. What we traditionally find in October, November, December, we're kind of like in the high 50s to low 60s days before travel booking. Again, I think it's a big component of that. The leisure traveler, they want to have their plans set before they go. They're sort of working on fares and things like that. So if you were booking 58 or 62 days out, for December or November travel, you were already booked, I think, before the shutdown. And so I don't think it changed people's plans much.
Yeah, makes sense. And so you think that there won't be much of a sort of material effect on numbers for the airlines?
No, so when we were all done, we kind of we took a 14-day window and we cut operations by actually 10% for all U.S. airlines and ran some calculations. We gave a little bit more load factor to the airlines because they're crunching more people on less flights. And essentially, when we were all done, we kind of, even with those numbers, which I think were a bit rich, maybe, we really think the airlines probably got 90% of their schedule, flown for the quarter, provided there are no other big interruptions. And that 98% part of the schedule with a little bit more load factor, it impacted some a little bit in profitability and margins. Some it improved profitability and margins. If you were flying regionals like American and maybe you shut down some of your regional business, which is a high cost business, maybe you got some slightly better profit and margins. So when we were all done, we just don't see a really big material change in expected results for 4Q because of the shutdown.
So let's zoom out and talk about holiday just more broadly here, George. As I just mentioned, 31 million travelers are expected to travel this upcoming Thanksgiving holiday. How, if we look at holiday overall, what are some indicators we should look for? Not just traffic, but what are some of the trends that we should expect to see?
Yeah, well, I mean, I think the challenge with the holidays is that everything gets channeled pretty tightly, right? And so everybody wants to get home for Thanksgiving, and so they're traveling usually this week, coming home on Sunday. I think Sunday's like the biggest travel day of the year, something like that. And so that's usually really good for fares for airlines. I've been hearing some of the recent trend is, if you can work from home or work from anywhere, maybe is the right way to say it. Maybe you pushed your travel plans into last week so you could find some better fares and such. So my guess is that the airlines, they'll do okay this holiday season, again, because of that channelized effect. But I think what we're seeing is consumers, especially in the economy basic end of travel, they're looking for deals. They're looking to save money. They feel a bit squeezed by inflation. So, my guess is that maybe fares continue to fall a bit into 4Q compared to 4Q last year because you've got those folks economizing. But if there's not too many interruptions too on the holiday travel season, again, I think we'll see results come in pretty close to what we expected when we started the quarter.
George, this morning I was digging into your survey for 2026, which I thought was really interesting, that the number of people who plan to prioritize vacations is lower than it was, 29% next year versus 36% a year ago. Did that surprise you? And then what are the implications then for travel?
Yeah, no, I think, again, it goes back to that trend I was just talking to you about, and that is we think in the sort of the basic economy ranks, those travelers are being squeezed by inflation. They're a little concerned about the outlook for the economy. And so some of the lower end sort of travelers are rethinking how important that annual vacation is. And then, by the same token, what we're seeing, or the flip side of that token, is we're seeing that those travelers that are a little bit better to do, they want to spend more on travel. They want a better experience. And this is really the trend we've sort of seen all year. And that is that the premium traveler doing quite well, demanding more out of their experience. The basic economy traveler is not doing as well, economizing, and some of that's pushing fares down.
And that also, I guess, has implications for the discount airlines, that the low-cost airlines might continue to sort of, like, it's been kind of a rough time for them. And is the implication that it will continue to be?
It is, so I think coming out of the pandemic, we probably built too much basic economy, capacity. We, meaning the airlines, they just added too much of that capacity to the marketplace. And so I think we'll have to rationalize that budget travel space. We're starting to see it, right? Spirit Airlines declared bankruptcy again, and we're trying to figure out ultimately, how much of a schedule they're going to fly next year. Some other airlines on the budget area, the travel experience, our financials aren't performing as well. JetBlue would be one of them, Frontier would be one of them. So I think capacity needs to come out of that part of the industry, and we're already starting to see it happen.
George, good to see you. Happy Thanksgiving.
Enjoyed it.
Appreciate it.
Thank you, you too.
Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. 90 minutes into the start of U.S. trading. I'm Julie Hyman. Let's get a check of the markets here. We are seeing an extension of Friday's gains for the major averages. Still the NASDAQ leading gains today. It's up by about 2%. Of course, tech was selling off the most during the recent downturn in markets. But today we're seeing a big lift. Stocks like Alphabet helping lead those gains. And the S&P 500 up about 1.2%. The Dow up just over 250 points or so, about 0.6%. TD Securities out with its global outlook for 2026, expecting growth to hold up relatively well. Let's talk about what all this means for the markets, particularly when we talk about FX. Joining me now, Jayati Bharadwaj, TD Securities FX and macro strategist. Thanks for being here.
Thank you so much for having me.
So let's talk about the big picture backdrop here for the economy, right? Because we keep talking about the K-shaped economy. We haven't had any economic data here in the U.S. for a bit. And so what do you think that the end of this year going into next year is going to look like?
I think we're definitely at a very pivotal point in markets. You know, there's definitely been a lot of conversations around what the next Fed move is, what is the state of the economy. Our view is that the global growth landscape actually looks a lot better than people were fearing at the beginning of the year. The world economy has been able to handle tariff shocks relatively resiliently. A lot of monetary and fiscal easing has definitely held it up, which we think should continue into next year, which should continue to hold the global growth backdrop relatively resilient. There's obviously going to be times when certain economies do better than others, but the pivotal focus now remains on the US. Europe and China, the other big economies, have been holding up much better than feared. In fact, we got headlines overnight about Russia, Ukraine potentially inching closer to the trade deal, which also takes away the tail risk away from Europe. China, shockingly, has been doing great. Exports year on year have been strong. In fact, they've been able to take a much proactive, stronger negotiating stance with the US, purely because their economy is doing relatively well. The US is the only big question mark now, where we are headed. In that, our view is that we do have some US underperformance relative to its potential in the first half of next year, which is where we're also off consensus in calling for a more aggressive path of Fed easing compared to what's priced by markets and our market peers. That is what we think is needed to then shield the economy and bring it back to potential in the second half of the year.
So do you think then that weakness on an economic basis will show up in, say, the labor numbers, and that will force the Fed's hand in terms of cutting rates?
Absolutely. In terms of the two things which the Fed cares about, the labor market and inflation, in the past 2 years, the Fed was caught wrong-footed by commenting that inflation is temporary. And then towards the end of the year, they were caught wrong-handed, and then immediately you had hawkish repricing of the Fed. So I understand that fear when a lot of Fed members have come out on the hawkish side, playing up the inflation fears. Unfortunately, it's ghosts of their haunted past. But I think that the bigger deal right now is the labor market, not the inflation like it was last 2 years. That will be pivotal in making the Fed either pause or cut. We obviously had only the September payrolls data. Unfortunately, September was already going to be a strong month because of seasonals. The main ones are October and November payroll reports, which unfortunately we will not get before the next Fed meeting, which is where I think it now all comes down to Powell and the key Fed members deciding between the balance of risks. We do think that even if the Fed were to pause, let's say for some reasons, the hawks outweigh the doves. The labor market reports, which will come out mid-December, will show a lot of weakness in the labor market, which will then again bring back a big talk of January cut. So irrespective of that, we do think that the labor market will point to weakness, which should move the Fed, if not December, definitely January.
I've talked to a lot of folks recently who are pointing to the fiscal stimulus that's going to be coming into play early next year, the sort of effects of the One Big Beautiful Bill and tax dollars that people will be getting back. If the Fed is cutting in that environment, do we risk overheating? Or do you think that labor weakness is enough that it needs to be offset regardless?
I think that's a great question, because in the past we have dealt with scenarios where there were risks of overheating potentially up until last year when the US was in that exceptionalism growth state. But purely because of the fact that the US exceptionalism has waned, the US has been growing below potential. There has been those fears of that K-shaped economy, which I'm sure you would have heard 1,000 times in the past few weeks. Those things will likely prevent that risk of overheating, because there is definitely the talk of AI, the capex investment, but that's all the top of the glacier. Underneath, there's a lot of weakness. The current equity market resilience, let's say, we're seeing in the US is different from any of the equity market rallies you saw post-2020, because they were cyclical in nature. Most of the sectors saw massive portfolio inflows and gains. This is the first equity market rally in many years, which is extremely inequitable, where the Mac 7 and tech have driven massive gains, but a majority of other sectors have seen outflows, which has important labor market implications. So even if we were to get that fiscal impulse coming in, I think that risk of overheating is definitely lower. In fact, what it will do is it will take away that tail risk of recession instead of taking you into overheating.
What are the implications of all of this for the US dollar?
I'm glad you asked that, because that's my forte. So we do have an off consensus call of calling another 6% lower in the dollar by the middle of next year. The dollar obviously has been a little stronger in the last few months, which was also our call. The dollar needed a positioning adjustment to go through, because at one point everyone was in the short dollar trade. But now thankfully positioning looks a lot more neutral and balanced out. We do think that the growing risks to the labor market, the Fed potentially having to ease a lot more than market is expecting, and ultimately at the end of the day, the global investors of the world not putting the dollar at that safe haven pedestal that they used to will play a key role into early next year. Mid next year is potentially when the Fed would have cut interest rates, let's say another 75 basis points to 100 basis points lower. That will actually bring down the cost of hedging the dollar exposure for foreign investors. We're not saying that foreign investors will start, selling US assets, definitely not. But every single foreign investor we speak to now wants to hedge the dollar exposure of their US asset holdings, which will become cheaper as the Fed cuts interest rates. So you can get a repeat of the move that you saw at the start of the year, again in the middle of next year, which leads to another drop in the dollar.
Do you think that dollar weakness on balance is a tailwind for U.S. corporate profits because we are so internationally, indexed? Or, there's always sort of a debate about the lower dollar. Is it good or bad for the U.S. economy?
Yes. That's definitely true. A lower dollar can have positive growth implications, can also have sometimes negative inflation expectations because of it importing inflation. Thankfully, the risk of that inflation importation is lower because of the tariffs and the pass-through which needs to come there. So if you focus on the growth side, it does make it easier for foreign investors to buy, U.S. products and assets. So that will definitely be a good thing. It can, allay some of the fears on the very downside. But more importantly, I think people's faith in the US assets will still remain, because there's no big challenge to, let's say, the US AI boom out there. No meaningful challenge from any other country out there yet. But unfortunately, the dollar is a big risk there. I'm not saying that people will start, central banks have been buying gold. That's also been a big question people have been asking, are people de-dollarizing? Those kinds of things will remain in place, but mostly from the dollar being a safe haven, not from a confidence in US assets, but mostly from the dollar being a safe haven, because the US is no longer shielded from the global shocks of the world, but has become the emanating source of them thanks to US policy uncertainty. And that has been the big shift, which I think will keep in play next year, because the administrators are not changing anytime soon.
Right, no, it is not, at least not for the next several years.
Yes.
Thanks so much, Shahidi, appreciate it.
Thank you so much for having me.
Coming up, as consumers deal with higher inflation this holiday season, there's still time for retailers to influence their decisions. We'll explain why next. As retailers gear up for Black Friday, the unofficial kickoff of the holiday shopping season, a study out from Boston Consulting Group shows consumers are willing to spend, and they're also very savvy when it comes to markdowns. Joining me now, Tiffany Ye, BCG partner. Tiffany, thanks so much for being here. I was really struck by the information that you sent us that people are willing to spend. And, we've seen some of the surveys out there that say spending could go up in the range of 3 to 4%. But it sounds like you guys are more optimistic than that even. Talk to me about that.
Yeah, in our recent survey, we actually found that consumers plan on spending meaningfully more this Black Friday season, 18% on average. And while inflation certainly plays a role in that, nearly 75% of them also told us that they'd been delaying recent purchases in order to spend more during this holiday season. Now, what are they spending that on? We really saw the increase across all different categories, and not just in gifts for others, but also for themselves and even essentials that they planned on buying anyways.
And how motivated are people by bargains? I mean, I guess they always are to some extent, but how much are they prioritizing, and will they wait for those promotions to come?
Yeah, of course. I mean, at the end of the day, consumers want simple, transparent promotions. What we actually found is that most seek those straightforward store-wide discounts. Up to 50 to 60% off resonated best. That being said, consumers are still savvy and they understand that different categories are going to have different promotion levels. What they told us is that their minimum expectation is about 30% off. That's what they perceive to be a good deal. And so it's going to be important for retailers to really balance their sales and margins and keep a disciplined but also nuanced approach this Black Friday season.
I'm curious about how people are shopping and whether, how well retailers are doing at meeting them where they want to shop.
Yeah, so what we're actually seeing is a continued return to in-person shopping combined with online shopping, really that hybrid mode. And what we found is that this holiday season, most plan on doing both. And that drive back in person is driven by the desire to touch and feel products before they buy them, be a part of experiential retail, and get personalized help from staff. And that's in line with what we've been seeing all year. Mall traffic continuing to go up, in-store purchases going up as that hybrid shopping becomes the norm. And I want to emphasize that point on hybrid because shopping journeys are really going across channels these days, including leveraging AI.
Tiffany, when we talk about leveraging AI, I was also shocked by the figure that you put in that something like half of people are going to use Gen AI when they're shopping. But does that include also that when I Google something, I get an AI response? Or is that dedicated people going to ChatGPT and Claude to do their shopping?
So that 50% is individuals who told us they planned on using ChatGPT and the like to help them in their shopping journey. And it's for more than just doing search. Yes, they're looking for what are the best deals and what are the best prices, but they're also using it to compare products and as well as to research technical information. And what was especially interesting to us is that while we only saw about 1 in 4 so far have used it to date in their shopping journey, the meaningful increase to that 50% is seen across generations. So not just your millennial and Gen Zs, but also your Gen X and boomers.
I don't know. I got to do a survey of the boomers in my life to see if that's, I don't know. I mean, yes, I know it's intention also, and reality might be different. We'll see. The other interesting thing I know that you guys are watching is if I'm a retailer and I want ChatGPT or whatever LLM they're using to scrape my site and give good information, do I have any control over that? How can I sort of tip the scales to make sure that it's showing up where it needs to?
Absolutely. Retailers have to be laser focused on how they're optimizing to show up in AI search. That starts with their own site. How do they optimize their product descriptions, their pricing, so that the large language models like ChatGPT are picking up on the right information? It's also about how do they optimize how they're showing up in product reviews, best of lists, so that their products are easily found.
Tiffany, thanks so much. Great to have you with us.
Thank you.
Much more markets action coming up. We'll get a check on trending tickers. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ here in Times Square. Let's get a quick check of the latest market action. We're about 2 hours into today's trading session, and we're seeing some renewed optimism on the street with all three major indices now in the green. Now, NASDAQ really seeing the most momentum here, up nearly 2.5%, up 2.3%. And this comes after we saw that stark sell-off on Friday that headed into the weekend, and now renewed optimism this Monday morning. And keep in mind, the NASDAQ is yet to regain the losses that they've seen over the past month, down nearly 2% on the month still. But the S&P 500 holding on to some momentum as well, up nearly 1.5% today, still down 1.4% in the last month, while the Dow up about 0.6%. 2 hours into today's trading session. But let's take a look at what exactly is driving the NASDAQ here, because we are seeing that renewed optimism around the AI trade in particular with NVIDIA, Google, Broadcom, Tesla, AMD, Micron, Intel, and Palantir all moving higher this morning. Let's take a look at NVIDIA, because we have seen that stock really see some turbulent times over the last 10 days. The stock is down nearly 8.5%. But as you can see here, some renewed hope around that AI trade, what exactly this will look like as we make our way towards year end. And that's why we're seeing the stock move higher this morning, up about 1.7%. I also want to take a look at Google, that company moving higher, up about 9% in the last 2 days. We also have Broadcom up about 10%. That's the largest gainer that I'm seeing on this screen right now, up about 8% in the last 2 days, up about 10% today. But while we're seeing lots of green in NASDAQ, we are seeing lots of just a little bit of red in cryptocurrency, but definitely not seeing as the same momentum that we're seeing there. If you take a look over the past 5 days, we did see Bitcoin cross and reach nearly that 81,000 threshold. Now we're seeing some renewed optimism around hovering around 87,000, but definitely it has been quite the month for crypto. Bitcoin in particular is down nearly 22% as people sort of took on this risk off appetite and definitely have pulled back. We also have Ethereum, which had some of its best months earlier this year. Now Ethereum has lost that year-to-date gain. It's down about 15% and up ever so slightly this morning. Once again, taking a step back, all three major indices moving higher this morning, with the NASDAQ leading the momentum, up nearly 2.4%. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves throughout the session.
Now time for some of today's trending tickers. We're watching Alphabet, Six Flags, and Amazon. First up, Alphabet, the parent of Google, extending its AI rally as shares see a sharp move higher. The stock has benefited from positive reviews of its latest Gemini AI model. Wall Street's also optimistic. BNP analysts reinstated their outperform rating today with a $355 price target. Alphabet has risen almost 13% this month and nearly 70% this year, by far the top performer among the Mag 7. This latest move, by the way, has put its market capitalization above that of Microsoft's, and the shares are trading at a record with this extension of gains. Next up is Six Flags, the ticker there, FUN. Shares are on the rise after the company announced a new CEO. Six Flags, remember, had been under pressure with shares sliding 72% this year. That has prompted activist investors to push for change at the company. JANA Partners and football player Travis Kelce partnered to push the amusement park operator to improve its marketing and customer experiences. John Riley will take the helm of the company in December. He currently serves as CEO of Palace Entertainment. And finally, Amazon, the e-commerce giant, announcing a $50 billion investment to expand its AI and supercomputing capabilities. The supercomputing investment in infrastructure will focus on serving government agencies. Amazon Web Services will build and deploy the first ever AI and high-performance computing purpose-built infrastructure for the U.S. government. Amazon will break ground in 2026 and will add nearly 1.3 gigawatts of capacity. We got much more markets action coming up. Stay tuned. You're watching Market Catalysts. The global economy is rapidly evolving, from shifting monetary policy to inflation pressures and structural changes thanks to technology. Here's what Allianz Chief Economic Advisor Mohamed El-Arian told our Brian Sazi at Yahoo Finance Invest when asked about risks.
So let me just say, we will have cockroaches, but not termites. And this is a fundamental differentiation. Cockroaches are unpleasant. They come in groups, but they don't eat away at the integrity of the system. Termites eat away at the integrity of the foundation. So why are we going to have cockroaches? We're coming from a period where people have stretched really far for additional returns. They have been encouraged to do so by a strong economy, by very loose financial conditions. And some people went beyond their comfort zone and beyond their ability to do due diligence. So I don't think we should be surprised that we will have these accidents, these credit accidents. We'll have some economic accidents, but I don't think we're going to have any systemic shock.
That is, of course, a good thing. And when you mention potential economic accidents, what keeps you up at night? Well, what are you most concerned about for 2026?
So what used to keep me up was a trade war. But the US has been able to impose higher tariffs without triggering much retaliation. So that doesn't keep me up as it used to. What does keep me up is what's happening at the lower ends of the income distribution for households, where there is significant pressure. And what keeps me up is the amount of debt that has to be refinanced at higher interest rates. So those two things are potential areas of pressure, which would be made worse if we get a policy mistake.
Mohamed, you bring up a really great point. It's something I've been thinking on very deeply of late. We've seen tremendous wealth created in the market this year, and the bull market has continued. But we're not seeing it, I guess this goes to your point, we're not seeing it translate into that average U.S. household, that lower income consumer. Is that cohort of the U.S., are they in a recession?
They're near recession, and they are spreading this concern about affordability, which is not just an economic issue, it's a social and political issue. The first shock to affordability was, of course, the 2021-2022 inflation shock. But that was offset, Brian, by income transfers. Now we have inflation stuck at 3%. We have insecurity about future income. The Challenger report showed you that layoffs were surging. AI will change the workplace. And in addition, we have high debt and credit cards that have been maxed out. So there is real concern on the bottom bit of what people call the K-shaped economy. And this is not isolated concern. If the lower household incomes stop spending, not because they don't want to spend, but they're not able to spend, that will contaminate upwards for the economy as a whole.
So you think that pressure on the low end, so the high income consumer, the person that is exposed to the markets, they've enjoyed a good year, they're not immune to what's happening on the low end.
So they're doing fine. They're doing fine from an income perspective. They're doing fine from a wealth perspective. So I'm not worried about middle to upper class. I am worried about lower income households and their ability to continue to navigate this uncertain environment.
How do we bridge this gap? Because if you listen to the current administration, Mohamed, they are talking, the president has floated a potential $2,000 dividend. There's been interest in that. The One Big Beautiful Bill was passed. More jobs are being created in the U.S. in terms of tech companies building out AI data centers. Like, how do you bridge that gap between what's happening on the high end and low end?
So they also, you could have added to that list that they've moved on some very sensitive prices, gasoline being one, and the other one being some pharmaceuticals. So they are taking steps, Brian, but this has been long in the making. This is not something that is recent, and therefore it is deep-rooted. It is made more complex by two other issues. One is the difference between real and perceived. And the other one is the difference between relative and absolute. So it is a really complicated issue, and if you go through it, the bottom line is it will take years of effort, both on the income side and the price side, to get us out of these situations.
I want to leave enough time in this conversation, Mohammed, because you are known as a foremost thinker on Federal Reserve policy. It has been quite the year for all things Federal Reserve, of course. Attacks from the Trump administration. We're coming up on the end of Chair Powell's tenure. Where is your head at as it pertains to the Fed in 2026? What is a new Fed chair? What will they bring? And where do you see the ultimate end game for rate cuts this cycle?
What a new chair will inherit is a divided Fed. And it's divided by two things. One is whether they are sensitive to the employment side of the dual mandate or to the inflation side of the dual mandate. Both are flashing yellow right now. So it does matter where your bias is. And what we see is that people are on both sides of this divide. The second thing that they will inherit is a division between people who are totally comfortable being backward-looking, so-called data-dependent, and those who realize they also need to be forward-looking. They need to have a strategic view of the economy, and in particular, Brian, of something you've been talking about a lot, AI and its impact on productivity and growth. So what a new chair has to bring is a unifying narrative. And I think that narrative has to be forward-looking. And the new chair has to have a view as to what the future economy looks like. I am a great believer, as you know, in the promise of AI. If we get diffusion right, we will have a significant productivity increase. And as a result, monetary policy will be able to be looser than it would otherwise have been.
Do you view the attacks on the Fed and what it does for the administration, will that leave lasting damage on this institution? And if you do think that's the case, what does that damage even mean to markets?
So I believe deeply in the independence of the Fed, deeply, that I think a Fed with policy autonomy is the best thing we can have. But I also believe, as you know, that this Fed went to sleep. There are many areas of reform that require attention. There are many best practices that from the rest of the world that we should be looking at more seriously. And there's lots of hard questions that we need to ask, including what is the right inflation target in a structurally changing economy. So the good news is you're starting to hear debate from within the Fed. You've had two Fed officials, as you know, come out and saying maybe we should have a range for inflation, our inflation target, not a point estimate. You've had another one come up saying we target the wrong intermediate policy variable. So I'm encouraged by the fact that the Fed itself is now finally talking about reforms. And that is something that, if you look at the 5 candidates on the short list, all of them understand that you need to reform the way the Fed operates. Otherwise, the Fed will continue to be behind. And if you look at the recent years, not only have we had decisions that were too late, but we've had a culture issue. We've had 5 officials that were accused of irregularities. So I think it's really important to reform this Fed. And what this political pressure has done is it has made certain Fed officials realize that it's better to reform from the inside than to have it imposed on you.
It's Thanksgiving week, and it's time to think about how much risk you're stuffing into your portfolio. Is it just right, or have you overloaded the plate and set yourself up for a Black Friday food coma? That's what we're breaking down today on Stocks in Translation. So let's start by building a Thanksgiving portfolio plate. We start with the main course. Turkey is your broad market core, S&P 500, the thing most of your calories come from. And right alongside, mashed potatoes and stuffing, our comfort food. Think defensive sectors and bonds. These positions may not be exciting, but they help keep your returns more stable when someone spills a big dish and everyone's reaching for napkins. Then comes the gravy. These days, that's your AI and growth exposure, tech, semis, the names that have done almost all the heavy lifting this year. Gravy makes a meal, but remember, you've already got a big chunk of exposure thanks to your turkey, the S&P 500. Watch out for concentration. Now let's move on to the second plate. Cranberry sauce is your speculative bets. The high beta ETFs, Bitcoin, crypto, the stuff that can light up the table or blow up your appetite. Ideally, it's a spoonful or two, not half the plate. And remember, not everyone likes cranberry sauce, and that's okay. Pumpkin pie is a fun money bucket. Single stock trades, meme names, tiny positions you size with care so that if they go to zero, you're still having a great holiday. Now that's the menu. Let's look at some strategies for serving up the main course, the turkey. In this chart here, we have the S&P 500 with two different weightings, the market cap version, the one we usually watch, and the equal weighted version, both over a couple years here. Cap weighted is like loading your plate with only turkey breast from the top 7 or 10 stocks. And to be fair, that's tasted pretty incredible during this 3-year bull market. The cap weighted index has crushed the equal weighted version, both short and long term. Equal weight, though, is the plate where you take a little bit of every part of the bird, some white, some dark, even a little wing. That gives you more industrials, financials, and some of the smaller names in the world's biggest stock market index. Just something to think about. Now we got to get into Thanksgiving family dynamics. Every year, we have the aunt who brings some unloved side dish. Here we've got small caps, REITs, or real estate investment trusts, and international stocks, which have actually done very well this year. But not everyone's piling into the green bean casseroles of the market right now. If you do, and it doesn't work out, you can always sell it at a loss and take the tax deduction. Whatever, just don't give it to the dog. Then there's the uncle who always insists on talking about uncomfortable politics. Here we have gold, the dollar, and foreign exchange, as well as those protest trades in crypto. This is where all the loud deficit talk shows up. And remember, he might have a few great points. And to be fair, gold is absolutely trouncing the S&P 500 this year. But selling the farm and buying physical might just be going a little bit overboard. Your job isn't to trade every hot take, it's to decide which of these actually fits your risk tolerance and your time horizon. Finally, here's our Thanksgiving week market checklist. With Wall Street traders away from their desks, lower liquidity can magnify moves. Headlines can theoretically hit harder, but most years, it's pretty smooth sailing. Nevertheless, we have seen some big surprises. In 2009, 2014, and 21, we got some pretty big Black Friday moves. Some were great buying opportunities, so watch out for those food comas. Friday's session is only half a day, from 9:30 a.m. Eastern until 1 p.m. And the Yahoo Finance team has you covered around both of the bells, and our editorial team will be bringing you the stories and stats that matter. That includes some of the big key numbers from the big box and cyber retail numbers that Wall Street will be watching and trading off of. And while you're waiting for the turkey to be carved, tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Stay tuned for more market catalysts up next.
Twenty 2025 has been the busiest year for IPOs since 2021, despite a slowdown during the U.S. government shutdown that saw fewer companies make their public debuts. According to research from the Connor Group, 2026 could be even stronger. They're anticipating a 20% increase year over year. And Jim Neeson, the Connor Group managing partner, is joining me now. And for folks who don't know, the Connor Group works with pre-IPO companies from a financial perspective as they go through the process. So, you have a lot of experience with this. So as we go into next year, I guess, first of all, let's talk about the government shutdown and whether that was a hiccup or something more significant. In other words, does it just pause and then everything resumes? Or does it throw more sand in the gears than that?
Yeah, I consider it like an IPO power nap. There's no doubt the 43 days of the shutdown did have it where companies were sort of delayed a little bit, right? November, half the number of IPOs you would expect in a traditional month. But for most companies, it's a little bit kicking the can down the road. When you're investing $3 to $5 million to make your company go public, you're not concerned if you go out in December or January or March. You just want to make sure you have a really quality transaction.
Well, I mean, are you concerned in terms of that market conditions can change? You know, particularly if you are, say, a crypto company that wants to come public and all of a sudden you're down 50% from the highs in terms of Bitcoin, then whereas at the beginning of the government shutdown, that wasn't happening, you know?
Yeah, 100%. I mean, in fact, a lot of times you might have thought you could go out sort of in this window, but all of a sudden now you need to do year-end numbers as opposed to September 30th numbers. So there are some crypto companies that it's not looking as sort of attractive in the marketplace as it did a couple months ago.
So you might see some timing changes, I guess, as a result of all of this.
Most definitely, most definitely. And it really, especially as you're talking with bankers and institutional investors, you know, sometimes they're sort of rising tide will lift all boats. What are sort of the verticals that are most interesting? But valuations in comparable companies can change.
So let's talk about next year. Why do you think it'll be even stronger than this year?
Yeah, you know, I think next year, really, if you look at the report card for 2025 IPOs, it was mixed, and I think it's a barometer looking at 2026. In terms of quantity, Connor Group, we're giving an A in terms of number of deals out there. Best IPO market since 2021, and you're also seeing a 50% increase from last year, from 2024. In terms of sort of the mix of IPOs out there, it's sort of a B grade, right? You saw SPACs are back. 40% of the IPOs were SPACs. You also saw private equity really jumping into the fray. The C grade, I'm going to give to sort of the performance around pricing, right? You know, that's what we're all talking about, right? A lot of companies, only 51% of the companies that went public in 2025 are actually trading above their IPO stock price. Now, your question for how we feel about 26, you're seeing really good forecasts from the major banks around the S&P performance for next year. Morgan Stanley is at 16%, Goldman Sachs is 11%. You have 1,500 private company unicorns really looking to go out there. And we've had 4 quarters in a row of really good earnings guidance from this S&P 500. So I think a lot of tailwinds to take us into 26.
Do you think that, I mean, and historically, you can tell me if this tends to happen, do you think that the companies that are coming public will learn the pricing lessons of 2025 and price things more appropriately next year so that they won't end up being below IPO price?
Yeah, you know, there's a lot of calculus that goes into it because you have your recommendations from your investment bankers, you have your board of directors. I think the key is going to be trying to find that sweet spot, right? It's an art and a science to price an IPO. I think for most companies, they'd like to sort of leave some money on the table so that way they could sort of have a good pop in the performance and then make sure they can kind of beat and raise in their forecast thereafter. If you miss your estimates, you're in the penalty box for a while. So I think you don't want it where your investors are unhappy within that first 6 to 12 months of a company going public.
This year really has felt dominated by sort of fintech and crypto IPOs. What do you think next year? Is next year still going to be the year of the crypto IPO?
Yeah, you know, I would say AI, fintech, the infrastructure plays, and even energy are really sort of hot sectors right now. The other ones we're going to see coming online in 26 will be software and SaaS and B2B and B2C. And the reason is they are weaving in AI to their business stories. So you don't have to be the pure play AI. It's actually how do you make your core business organically have AI as a way to scale and build volume, drive revenue, and drive profitability. So I think you're going to see AI woven into all these stories, but the investors want to make sure that it's in a real way that's sort of true to the business.
What do you think the hottest IPO of 26 will be?
You know, I'd say there's probably 5 or 6 that will be on our radar. There's a Databricks, there's a Stripe, a Plaid, Cerebras, Kraken. You know, I think there's some really good companies that I would call sort of the IPO Olympic sort of gold medal type of companies out there. We're also going to see a really big wave of sort of mid-cap and small-cap companies as well. These are the ones that have been in the IPO gym preparing for the past 12, 24 months. And specifically when the pendulum opens up, those can be some really quality companies that, to your comment, they're not going to overprice. They're going to want to go out there, leave some money on the table, but give really good performance to the retail investor.
And lastly, Jim, I'm really curious, as someone who's been doing this for a long time, I sometimes hear from folks on the private side of the ledger, so many companies stay private for so long because it's too onerous to go public. Like, there's a lot of public companies. It can't be that onerous. But I'm curious from your perspective, especially dealing with the financials, what you hear on that front.
Yeah, you know, I mean, so at Connor Group, we've done 265 IPOs and they're worth $4 trillion. We have a lot of private companies now because when you raise substantial cash, it gives you the ability to have more runway to build and scale the business. I think often if your revenue is 1.5x what it would have been otherwise, or maybe instead of a line of sight to profitability, you hit profitability, it typically can be easier to go out into the public company markets. So I would say cash is a really big consideration. I think the other is having a really good feeling on being able to forecast your business. You want to make sure you can beat and raise. So for a lot of companies, getting some more time, you can sort of, I use the analogy of the gym, get more exercise in, get looser, but when you're on actually the performance court, you're ready to sort of be in the big time.
Okay, thanks so much for coming in.
Thank you, Julie, quite a pleasure.
That's it for Market Catalyst. I'm Julie Hyman. Thank you for watching. We got more Yahoo Finance coming up.